Have you ever wondered why banks exist and what they actually do? Perhaps you've thought of banks as just places where you store your money, right? Well, there's more to it than that. Banks, in their simplest form, are institutions that safeguard our deposits, but they don't just sit on our money. They put it to work. Banks use the deposits they collect to offer loans to individuals and businesses. These loans stimulate economic growth by enabling consumers to make big purchases and businesses to expand their operations. Imagine for a moment a world without banks. Where would we secure our money? How would we borrow funds for a new home or start a business? The role of banks in the economy is indeed crucial. But banks don't just safeguard deposits and offer loans, they also facilitate transactions. Every time you use your debit card at the grocery store or make a payment online, it's your bank that's making it happen. They ensure that money moves smoothly and securely from one account to another. This function is key to the efficient operation of our modern digital economy. Banks also play an important role in the creation of money. Yes, you heard it right. When a bank gives out a loan, it doesn't hand over money from its vaults. Instead, it simply creates a deposit in the borrower's account. This process increases the total amount of money in the economy. It's worth noting that banks operate under a trust-based system. We trust them with our money and they trust us to pay back our loans. This mutual trust is fundamental to the functioning of the banking system and, by extension, the entire economy. So the next time you walk into a bank or log into your online banking account, remember that you're not just interacting with a place to store money. You're engaging with an institution that plays a pivotal role in the functioning of our economy and our daily lives. Banks, as we see, are not just about storing money, they are pivotal to the function of the entire economy. Why does money in a bank grow over time? The answer lies in a simple yet powerful concept: interest. Now let's break it down. Imagine interest as the price you pay for the privilege of using someone else's money. And on the flip side, it's also the reward you get for letting someone else use your money. That's right. When you deposit money in a bank, you're essentially lending them your money, and they pay you interest as a thank you for the loan. But the bank doesn't just store your money in a vault, they put it to work. They lend it out to other customers who need a loan, maybe to buy a car or a house. And here's the kicker. The bank charges these borrowers a higher interest rate than what they pay you, the depositor. The difference between these two rates is how banks make their profit. Let's illustrate this with a simple example. Suppose you have deposited $100 in your bank account, and the bank pays you 2% interest annually. By the end of the year, you'll have $102. Now, what if the bank lends out that $100 to someone else at an interest rate of 6%? They'll earn $6 from that loan, subtract the $2 they paid you, and the bank just made a $4 profit. So, in a nutshell, the concept of interest creates a win-win situation. You, the depositor, get a reward for your savings, while the bank earns a profit from lending your money out. But remember, the borrower also benefits, as they get access to funds they might not have had otherwise. But why is interest so important? Well, it's a foundational element of our financial system. It encourages saving, promotes investment, and helps keep the wheels of the economy turning. So the next time you see your bank balance growing, remember, it's not magic, it's interest. And it's not just a number, it's a powerful tool that fuels economic growth and prosperity. Interest, in essence, is the cost of using someone else's money, and that's how banks make a profit. What if I told you that your money could multiply itself? Welcome to the world of compound interest. Let's dive right in. Imagine compound interest as a snowball rolling down a hill. The more it rolls, the bigger it gets. That's because as it rolls, it's not just collecting snow from the ground, it's also picking up the snow that's already stuck to it. This is the essence of compound interest. Your money isn't just growing, it's growing on top of growth. Let's break it down. Compound interest is the interest calculated on the initial principal, which also includes all the accumulated interest from previous periods on a deposit or loan. This means that the interest is effectively interest on interest. To illustrate, let's say you have $100, and you put it in a bank that offers 5% annual interest compounded annually. At the end of the first year, you'd have $105. That's your original $100 plus $5 interest. In the second year, you're not just earning interest on your original $100. You're earning interest on the full $105. So by the end of the second year, you'd have $110.25. That extra 25 cents, that's the result of compound interest. And this process continues year after year, with your money growing at an accelerating rate. The magic of compound interest doesn't stop here. The more frequently interest is compounded, the greater the overall return will be. This could be monthly, daily, or even continuously, and each time the interest is compounded, it's added to the principal, which in turn earns more interest. Now imagine if you keep adding to that initial deposit over the years, or if you start with a bigger amount, or if the interest rate is higher. The end result could be a substantial sum of money, all thanks to the magic of compound interest. Compound interest is the secret ingredient that can turn a small amount of money into a substantial sum over time. Is your money safe in a bank, and what's in it for them? These are two questions that often come to mind when we think about our hard-earned cash. Let's dive in and explore the concepts of risk and reward in banking. In the banking world, risk is ever present. It's the possibility that the bank will lose money on an investment or loan. This could happen if a borrower defaults on a loan or if an investment goes south. Banks are always striving to strike a delicate balance between risk and reward. The higher the risk, the higher the potential reward. But the converse is also true. The higher the risk, the greater the potential loss. So how do banks manage these risks? They use a variety of methods. First, they diversify their investments and loans. This means they spread their money around, investing in different sectors and lending to a variety of borrowers. Secondly, they conduct thorough risk assessments before approving loans or making investments. This involves scrutinizing the borrower's credit history, financial stability, and ability to repay the loan. But what about your money? Is it safe? The answer is yes, thanks to deposit insurance. In many countries, deposit insurance schemes protect customers' deposits up to a certain limit if the bank fails. This means you won't lose your money even if the bank goes under. Now you might be wondering, how do banks earn money if they're taking on all these risks? Well, banks earn money by charging interest on the loans they provide. The interest rate is often higher than the rate they pay on deposits, and this difference, known as the net interest margin, is where they make their profit. They also earn money from service fees and charges. So banking, at its core, is a business of managing risk to reap rewards. Banks take calculated risks to earn profits, while also ensuring they protect their customers' deposits. The delicate balance of risk and reward is what makes the banking world go round. And as customers, understanding this balance can help us make informed decisions about our money. Remember, banking at its core is a business of managing risk to reap rewards. What role does a central bank play in our economy, you might ask? Well, the answer isn't as complex as it might sound. Central banks are, in essence, the backbone of a nation's economic system. They control monetary policy, which includes the regulation of money supply and interest rates, and they ensure the overall stability of the financial system. Imagine the economy as a vast ocean. In this ocean, the central bank is the lighthouse, providing guidance to the ships, the banks and financial institutions, navigating through the economic waters. These ships rely on the lighthouse to steer clear of dangerous reefs, or to find their way home in a storm. This is the role that central banks play in our economy, but how do they do it? Well, central banks manage the money supply through a process called open market operations. They buy and sell government bonds to either inject money into the economy or pull money out of it. This helps to control inflation and stabilize the economy. Interest rates are another tool in a central bank's toolkit. By adjusting these rates, central banks can influence how much people save and spend. When interest rates are low, people are more likely to borrow and spend money, which can stimulate the economy. On the other hand, when interest rates are high, people are more likely to save, slowing the economy down. Lastly, central banks play a crucial role in maintaining financial stability. They monitor the health of banks and other financial institutions, stepping in when necessary to prevent financial crises. They serve as a lender of last resort, providing funds to banks that are short of liquidity. This ensures that banks can meet their commitments and continue to operate, thus preventing a domino effect that could lead to a systemic financial collapse. So, the next time you hear about a central bank adjusting interest rates or buying government bonds, remember that these actions are part of a larger strategy to guide our economy through the highs and lows of economic cycles. Remember that central banks are the lighthouses in our economic ocean, providing guidance and stability. Central banks steer the economic ship, ensuring smooth sailing for all.